Most traders do not blow accounts because they don't know how to trade. They blow accounts because they do not know how to use leverage. Today and in this video, I am going to show you exactly how to use leverage safely, the best leverage strategy for beginners, and how to protect your account from blowing. Hello traders, welcome back to FinSpoke. My name is Juliet and here we teach you simple and practical ways to trade financial markets with confidence and stay profitable. Let's go. What is leverage? Leverage simply means borrowing money from your broker so you can control a bigger trade size with a smaller capital. Think of it this way: your voice and a megaphone. Your voice is small and a megaphone helps your voice to be louder. So in this context, your account is small and leverage makes it to be big. For instance, when you are creating your account and you choose a leverage of 1:100, what it means is this: for every $1 you have, you are controlling $100 in the market. So with $10, you can control $1,000 in the market. That's what leverage means or what it does for you. However, listen carefully because this is where most traders fail. Leverage increases your potential profit. Why beginners blow accounts using leverage? Most beginners pick a crazy leverage when they are creating their account. For instance, some of them pick a leverage of 1:1,000, 1:2,000, and enter a big lot size. The moment the market moves small against them, boom, the account is gone. The problem is not leverage itself. The problem is lot size and the risk management. And that is why we say high leverage plus bad risk equals blown account. And the low leverage plus controlled risk equals account longevity. Best safe leverage for beginners. As a beginner, this is a safest approach for you. The recommended leverage is between 1:50 and 1:100. Why? Because it allows your account to breathe. 2, it prevents oversized trade. 3, it reduces the chances of margin call. And 4, it forces you to respect money management. And this is what gives you consistency as a beginner if you adhere to it. The 1% safe rule strategy. This strategy protects small accounts and gives you long-time survival in the market. It is in 3 steps. Step number 1, risk only 1% of your account size per trade. If you have $100, risk $1. If you have $200, risk $2. Do not risk $10 or $20. Just 1% of your account size is good. This is how professionals trade. They protect their capital first. Step 2, use a small lot size. 0.01 lot for small accounts, 0.02 to 0.05 for a growing account. Do not use 0.1 lot until your account is up to $500 to $1,000. Don't let greed control your fingers. Step number 3, combine your leverage with small lot size. Here is the secret nobody tells you as a beginner. Leverage does not blow your account. Lot size does. With 1:50 leverage and 0.01 lot size, your account becomes stable. With that, even if market goes against you 20 or 30 pips, your account will never panic. This is why experienced traders barely blow accounts. They understand the balance. Let's look at these few examples and do the real calculations. I'm using Euro USD, for example, and this example one is where we use a good leverage. Let's say you have $50 in your trading account. You choose 1:50 leverage and use 0.1 lot size. If the market goes against you by 20 pips, your loss is $2. How did we arrive at $2? 0.1 cent is the monetary equivalent of this 0.01 lot size. Look at the rough here. When we are calculating the lot size, 0.01 is calculated at 1 cent. 0.1 lot size is calculated as $1, and the 1 lot size is calculated as $10. That's how we arrive at $2. Your account is still safe because if you remove $2 from that $50, you still have $48. This is how beginners survive long enough to learn. Now look at this example too. The same Euro USD, but bad leverage. These are the reasons why accounts are being blown easily. The same $50 account, but you choose a leverage of 1:500 and use 0.20 lot size. That's 0.2 lot size. The market moves only 20 pips, as it was in the first example, against you. Boom, you lose about $40 from the account. Know how we arrive at $40? 0.1 lot size is calculated as $1. So 0.2 lot size means that is $2 times 20 pips. And we arrive at $40. When you deduct $40 from that $50 account is almost gone because the balance there is $10. And with the fear, the panic that's already set in, when you lose that $40, it will be difficult for you to grow that account again. Same trade, same pips, different leverage plus lot size, different outcome. Now, the problem here is lot size, not really leverage. Understand how this works and become consistent without blowing your account. Let's look at this also in reality. Account size here is $100. The leverage is 1:50 and the lot size is 0.01. The SL is 30 pips. I hope you know how we calculate this SL. When you get your point of interest, from your entry point, you count backwards. If you are using Euro USD, 30 pips or even 40 pips is okay, provided your lot size is small and you are using a good risk management. If you are dealing on gold, at least 50 pips is okay. 50 pips backward is okay. So possible loss with this account and lot size will be only $3. If you use 0.01, the loss is $3. If you minus $3 from $100, which is the account size, you will have $97 left. This is still within your risk management, and you will still be confident enough to continue trading or to stay consistent. But if you use high leverage incorrectly, like leverage 1:500 with a lot size of 0.2 and the same 30 pips, if the market go against you, it's going to be $3 multiplied by 30, which is the 30 pips. Lose about $90 from the account. Account is almost gone in one trade. I hope this helps somebody. Do me a favor by sharing this video. A lot of beginners need to understand this so they stop blowing accounts, especially as we enter into 2026. Blowing accounts is one of the reasons why people see trading as a scam. It is not a scam. It is just misinformations people consume at the beginning. If you are struggling as a trader or you are just starting, check out these videos. It will help you a lot. The golden rule of safe leverage. Number one, never use leverage above 1:100 as a beginner. Two, always combine leverage with a small lot size. Three, never lose more than 1 to 2% of your account size per trade. Four, use stop loss always. Stop loss is not against you. Stop loss simply means I don't want to lose more than this. Always use it. Five, focus more on account protection, not quick profit. Six, your leverage doesn't determine your success. Your discipline does. Every trader wants to flip account fast, but traders who last, traders who win, are the ones who understand leverage. Leverage is not your enemy. Lack of discipline is. Use it wisely, protect your account, and you will see consistency. If you want me to make a video on lot size for every account, drop lot size in the comment section. I will sit back to respond and to read your comments. And don't forget to like, subscribe, share for more trading education. Till I come your way next time. Peace.